Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinnii Motiwala with me, Sonal Bhutra, as well as always. Sonal, today we're going to be putting the spotlight on a very interesting topic that's picked up a lot of pace, right, and interest as well, factor funds.
Oh, yes, and we've seen that massive rise in their AUM as well. And that's exactly what we are going to be talking to the viewers about as well. What makes it a favorable space, this particular category in the volatile market, the assets under management, they have been increasing rapidly. Right now, they are around 35,000 crore rupees. So to talk more about this, we have with us Sanchita Mukherji, Managing Partner and Mutual Fund Distributor at Talk the Walk, and Nisreen Mamaji, CFP Founder at MoneyWorks FS. Ladies, good afternoon. Thank you so much for joining in. Nisreen, we are twinning as well. And also we've got a lot to talk about today. Let's get started then. The first question to you is to you, Nisreen. What has led to this sharp surge in investor interest when it comes to factor funds? The AUM has been consistently increasing. How much has it risen by over the last couple of years?
Sure, that's a very interesting question, and yeah, we look very good together on the screen. Basically the AUM is around 35,000 crores of the factor-based funds, and it's really sharply increased, especially after 2021, because we started at around 1,000 crores and we've nearly reached 35,000 crores. Now, the reason for why this swing has happened basically is, the people feel, obviously it's very sentiment driven, that there is a potential for higher returns in this category of funds because it, kind of focuses on, say, various factors that can drive the market. So because, the human intervention is not, is taken away from the entire stock selection process, the sentiment is that, this kind of a fund will give you a potentially higher return. Also, in case of, it also provides an alternative and diversification with traditional mutual funds or traditional investment products. So based on that, also people like to, try something new. And this is a fairly good alternative, from the passive side as to what, to the traditional investments. Also, when you're trying to navigate a market cycle, a factor-based fund would definitely add some value because it could, it's potentially able to adapt to different market conditions, and that makes it very appealing to investors because of the navigation point of view. Also, there is increased awareness and accessibility now because of the rise of digital platforms. Campaigns are, running throughout, and this makes the accessibility to a wider audience possible, including for retail investors. Also, there are technological advances actually, which gives you an improved access to data and to advancements in tools like AI and big data analytics. So, from the fund management point of view, also this progression will give a surge to factor-based kind of products, and also it's a multi-factor approach that a person can adopt. So if you create, if you take advantage of a lot of factors, it gives your portfolio a lot of balance and robustness. So that's some of the reasons why factor-based have really done well recently.
Absolutely, nicely summarized. A lot of reasons, actually, some of those reasons that are pointed out by you as well, Nisreen. Nisreen, as well as Sanchita, good afternoon. Sanchita, anything that you would want to add furthermore to that? And also, in terms of factor investing, does it help investors across different market cycles? Does it evade some sort of risk that you may have due to market volatility? Which factors work in which market cycle?
Excellent question, and thank you for having me. I would just add on to what Nisreen was saying. In fact, I just deep dive into what exactly is factor investing and what are we talking about when we talk about factor funds. So factor funds, as she rightly mentioned, it's a subset of the passive style of investing. So traditional products in the passive style of investing would be your traditional index funds and all of that. So within that, if you were to take a subset, which you define as factors. Now, what are these factors? Factors can be, say, a momentum factor. Factor can be a value factor. Factor can be a quality factor. Factor can be a volatility factor, right? And a factor can be a multi-factor, for example. But they're all a subset of the passive style of investing and not really the active fund management business of the mutual funds. Now, when we're talking about each one of these factors, a single factor may or may not, depending on what the factor is, what the market cycle is, what is the methodology the fund has adopted. Depending on all of that, they may and may not actually perform through various market cycles. For example, momentum factor funds typically tend to do well in bull markets, right? It may not actually do very well in a market which is ranging sideways or going range bound. Similarly, but on the other hand, if you were to look at value factors, if you were to look at volatility factor funds, they typically tend to do better when there is sharp volatility in the market, when there are sharp drawdowns happening in the equity market. Their chances of going negative is actually much lesser than your traditional index fund, right? So therein your returns are kind of protected and your volatility is protected. Similarly, value-based factor funds can perform well when typically the markets are trying to get out of a rut and going on an upward swing. Value can emerge as a good factor to have in that case. However, most commonly used term for factor investing, in something that most investors are comfortable with, are the multi-factor investing, because multi-factor is very, very well balanced, as she rightfully mentioned, and typically tends to look at all aspects of the market in terms of if it's range bound, volatile, all of that.
Take that point. So let's take this point forward. Nisreen, let me come to you. What are some of the factors that fund houses are considering while creating a factor-based fund?
Sure. So, one can be value, and what it actually means is stocks that appear cheap based on fundamental metrics. Okay, and the kind of metrics that we could be using are price to earnings, price to book, dividend yield, or EBITDA. So if you're using any of these metrics, and if it appears to be cheap, the stock, then it would be considered a value factor. Momentum, on the other hand, is when the stocks have shown, a very recent great performance, and you feel that this is going to continue for a period of time. Now, here the metrics that would probably be used would be 6-month and 12-month price returns, relative strength versus peers or the index. And here the logic is that the capital chases winners in the short term and creates a very positive feedback loop. Okay? So that's what value means, momentum means. Then when you're looking at quality typically means a financially strong company with a high earning and a low debt. Okay, so that kind of a company would be, as per the factor base, would qualify for a quality company. Metrics used would be return on equity, debt to equity ratio, profit margins, earnings, and stability. So if you apply these metrics and you pass all the possible bands, you would qualify for a quality company. Another factor is low volatility. What that means is stocks with lower price fluctuations. Okay, so metrics here that would be used would be standard deviation of the returns, the beta, that is volatility versus the market. And here the logic would be it's a more stable stock which would perform on a risk-adjusted basis, especially in volatile markets. Then you could also have size as a factor, like, say a small cap fund, a small cap tilt. And what it means is that a smaller company has a higher growth potential. And here the metrics would be, probably market cap. So anything below 250 in the market capitalization would be considered a small cap company, and this is a small tilt. And historically, the smaller companies have outperformed larger ones over a longer period of time, of course, because that would definitely be the disclaimer. And it also carries a higher risk. So such a company would be following a factor of small tilt. And lastly, you have a multi-factor strategy where a factor-based investment can be done with not only one, but a variety of the above factors, thereby, completing the entire range and also offering, a safer strategy for the investors. So these are some of the strategies that are typically being followed. Yeah.
Okay, the typical strategies that are being followed over there: value, momentum, quality, then there's size also that comes in as well. But Sanchita, does this, actually turn out to be riskier than those traditional categories that we invest in? And how have factor funds actually performed versus and vis-a-vis a non-factor fund?
Really good question. Yes, a single factor will not perform across market cycles. Now, so that by that logic, you're quite right in saying that are they termed riskier? However, a multi-factor fund might actually lend that bit of diversification and stability to the portfolio. That's for sure. And when we were to talk about performances, let's understand now, factor funds are a subset of the passive investing, right? Now, the mutual fund industry as of 30th of June was close to 74.4 lakh crore in terms of AUM, and out of which the passive in investing itself is close to around 12.11 lakh crore as of 31st of May 2025. Now, within that, within the passive subset, if one were to look at factor investing, it is a small subset. So the returns are really not there across market cycles and outperformance to really benchmark whether in reality they have beaten a tried and tested index fund, for example, a traditional index fund which invests across in the broader markets, or whether a factor fund has actually outperformed across various market cycles. That data is not there for us to say very substantially that this kind of a strategy really works in the long run. Now, when it comes to factor funds vis-a-vis an equity diversified, actively managed fund, that is a different debate altogether. Because there, a factor fund, what it does is it's very rule-based kind of investing. There are a set of parameters, methodology, rules, and like she rightfully mentioned, it is a lot of it is system generated and it is invested in that manner. Whereas in the active funds, in equity diversified active fund space, you have the manager. So on one hand, you have the opportunity to dip into the fund manager's alpha creation, in which India offers a lot of opportunities in alpha creation. Or if you want to eliminate the manager risk altogether, one could look at factor fund investing.
Take that point. Let me come to you, Nisreen. What are some of the factor funds that you would recommend for our viewers?
Sure. So, if you are an aggressive investor and you're aiming for high returns and you want to ride the short-term trend, then a very good fund would be a momentum fund, which is the ICICI Prudential Nifty 200 Momentum 30 Index Fund. This tracks the Nifty 200 Momentum 30 Index. The past one-year returns have been about 35%. It's a low-cost, consistent performer, and it's great for an SIP or STP for 5 years as well. Then, you could, if you're looking for, also in the same category, the Motiwala Oswal Nifty 500 Momentum 50 Index Fund is also a good alternative. Here, the universe is slightly larger. It's the Nifty 500. So it would have mid caps and a small cap exposure as well. Slightly volatile, but good for higher return in the longer term. If you're looking at quality in factor, you could look at, this would give you stable returns, protection in the downturns, and it's suited for an investor with a moderate risk profile. So here, one could suggest the Edelweiss Nifty 100 Quality 30 ETF. And this focuses on companies with a high return on equity and a low debt. Also, historically, it's protected the downside. So, for a moderate investor, this would be great. Also, the SBI Quality ETF, which tracks the Quality 30 Index. Then for the low volatility funds, here you're looking at equity exposure, but with less fluctuation, because that's what a low volatility investor would be looking for. And it's for a risk-averse investor. You could be looking at ICICI Prudential Nifty Low Vol 30 ETF. And this is very good for, say, a retiree or a person with a very low risk profile and conservative equity investor. And, it's especially in the bear markets, it would do very well. Also, the Nippon India Nifty Low Vol 30 Index Fund. It's a newer option, but it is gaining, very steady AUM, and it blends very well with growth funds, in any portfolio. If you're looking at multi-factors, which is combining 2 to 3 factors, like it could have quality, value, low vol, for a very balanced kind of a strategy, you can look at ICICI Prudential Alpha Low Vol 30 ETF. It tracks the Nifty Alpha Low Vol 30 index, and also it's has a slight tilt towards momentum and low vol for the risk control. Or you could look at the Kotak Multi-Factor ETF. This tracks the multi-factor index, which is value, quality, momentum, and low vol. So this is a very smart beta solution for a passive equity investor. So these are some of the choices. And, if you're conservative, then go for low vol or quality. If you're moderate, go for multi-factor or quality.
Okay.
If you're an aggressive investor, go for momentum or alpha and low vol.
Okay. Nice list that you've given over there as well, and viewers will surely, be happy with that list coming in there. But on that note, we're going to step into a very short break, and on the other side, we're going to be discussing liquid versus arbitrage funds and which one is a better option for our viewers. So stay tuned for that.
Welcome back. You're still tuned into MF Corner. We still have with us Sanchita Mukherji and Nisreen Mamaji. And in this segment, we are going to be focusing on liquid funds and arbitrage funds. We've seen that savings rate cut that has come by. So does it make these short-term funds in focus? Sanchita, let me start with you this time. Liquid funds versus arbitrage funds. What is better for short-term?
Thank you so much. It's better than keeping the money in the savings account because both of these categories offer a bit of close to around 1.32% to 4% kind of a differential with the savings account rate. So savings account would be close to around 2.5 to 5.5% in the savings accounts, depending on the bank you're in. Liquid funds, slightly higher in terms of their historical indicative returns have been close to 6 to 7.5%. Similarly, with arbitrage funds, 6 to 7.5% historical indicative returns. However, the differentiator would be in arbitrage funds, the tax efficiency sets in because these are equity tax rates which are applied on the arbitrage funds. In the liquid funds, they are taxed at marginal rates. So if your slab rate is lower, actually, you might consider it. If your slab rate is in the highest rate, you might like to park your funds in the short term in arbitrage funds.
Okay. Nisreen, I'm going to come to you. What would you say? Which one is the better one for the short-term liquid funds versus arbitrage funds? And obviously, like, Sanchita and even Sonal was mentioning that, interest rates have gone down. So would it make sense also to start shifting to that short-term mutual fund then or parking your funds over there now?
So yes, it does because the differential is in your savings account, as Sanchita's already mentioned. So there is a spread of at least, 2 to 3% or 2 to 4% that you could be looking at by making these small changes in the portfolio instead of leaving it idle in your savings account. So, especially liquid or overnight funds make a lot of sense if you want, the liquidity. And you can have potentially higher returns, keep the liquidity, constraints in place. But you also have to understand the risk. When you're moving from a savings bank account to, say, even a liquid fund or an arbitrage fund, you'd obviously have to, the pros would be that you're potentially higher returns. Spread is between 2.5 to 4.5%. Liquidity is there. Like in an arbitrage fund, you will get your money back after 2 days. In a liquid fund, you can get it back the next day. It's low. It's not very high risk. In a liquid fund, it's also very, very pretty much a safe instrument. You can compare it to a banking product also, but the risk of losing your money or not getting your principal back or not getting the interest back is very low. And also for a very short-term goal, it's a pretty good sense to keep your money in either of the two options. Of course, it depends on the tax bracket that you are in. That's already explained by Sanchita. So, obviously these kind of products are not completely risk-free because there's, you have to understand that they are in mutual funds eventually. And so the disclaimer will always be there that there is no guarantee for these products. If you keep it for a longer period of time, you may not beat inflation. So make sure that you use both liquid funds and arbitrage funds as a parking instrument for a very short-term period. The tax implications could arise in both marginal tax rate for the liquid fund capital gains for arbitrage. So, it would be also making sense to use a combination of both these strategies and not rely on either. So, whichever tax bracket you are in, if you use a combination of ultra short duration funds, money market funds, and liquid funds, then, I think that you will, based on your investment horizon and risk appetite, you will be able to match your goal.
Okay, that is quite a comprehensive answer to most of the things that we wanted to cover as well. Sanchita, coming on this, what would your end comments be? Because you have pretty much covered everything and we have around 2.5 minutes on the show as well. So please go ahead and tell us what is the synopsis that you've made of parking things into liquid funds or short-term funds, considering other factors like risks as well, as Nisreen mentioned.
I'm so happy that she mentioned the risk factor because, yes, mutual fund returns and the product itself is not guaranteed. But having said that, it is a wise decision sometimes to park monies into these short-term options and not just keep it lying in the savings, because inflation is very much there. I was just calculating the historical average inflation from 2015 till date is close to 5% in India. So if one were to look at very short term, say less than 6 months, one can definitely look at liquid funds, which are essentially money market instruments. And the taxation on that, although I'm not a tax expert, this is a mutual fund incidental advice that is there. The taxation is close to the marginal rate of tax slab that you're in. So if you're at a lower tax slab, that is an additional benefit that you get by parking the money in a liquid fund, because you get to earn that much more incremental, slightly more, say around close to 2.5% over the savings bank rate. So for sure, arbitrage funds, I would just like to point out one small note that anything less than 6 months is kind of avoidable to park it in an arbitrage. Arbitrage typically performs well from 6 months to 1 year as a bridging fund, right? Less than 6 months, the methodology it adopts. What does an arbitrage fund do? Essentially, it tries to make use of the arbitrage between the cash and the future market by making itself market neutral, not having a long call or a short call or anything of that sort. A market neutral, but less than 6 months, essentially what happens, volatility might set in vis-a-vis even the savings account. So if your horizon is above 6 months, one could definitely actively look at arbitrage funds as a bridging fund.
Okay. So less than 6 months, then do not go for it, right? 6 to 12 months, somewhere at that time period is what one could go for in terms of arbitrage fund. But, with that, we are actually absolutely out of time on this edition of Mutual Fund Corner. So thank you so much, Sanchita, as well as Nisreen, for joining you with us on the show, explaining us, different factors that come into play for liquid and arbitrage fund and when we should be opting for that as well. And thank you so much for the discussion previously as well. But with that, we'll wind down this edition. Thank you so much from Sonal, myself, as well as the team who put this show together. But don't go anywhere. Up next, we have Closing Bell to take you to the last hour of trade.